Analysis report explores the bullish case for Poet Technologies.
Hmm.
The argument is that a recent $5 million production order validates the company and justifies a high-end analyst price target of $7.77.
Which is, what, about a 55% upside from where it's trading now?
Exactly. Now, the report makes a really strong case for this commercial shift, highlighting that big order and, its position in the whole AI infrastructure wave.
It does. The conviction is definitely there.
So let's get right into the feedback, focusing on how to make this analysis truly robust for let's say, a very skeptical reader.
I think that's the right lens. And for me, the first and maybe the biggest hurdle is that we need to fully bridge the gap between all that future potential and that very specific $7.77 valuation.
Ah,
Right now, it feels like we're relying a bit too much on just quoting a third-party analyst.
so the core issue is the quantitative backing, or, well, the lack of it, for that eye-catching number. The justification for the valuation.
Precisely. The analysis, it correctly cites that analyst's high of $7.77.
Mm-hmm.
And it mentions it's based on the 2026-2027 growth curve and comparable semiconductor multiples. But the calculation itself, it's just not there.
It's a black box.
It is. The valuation relies purely on that quoted opinion without giving us the underlying numbers to, justify it ourselves. For a professional reader, that's a pretty critical gap in the logic.
I see what you mean. It sort of moves the piece from being an analysis to just being a citation.
That's a great way to put it.
Relying only on the quote prevents the report from truly owning that number. It doesn't articulate why 7.77 is the right target, instead of, say, 6.50 or maybe 850.
Right.
You're asking the reader to trust the conclusion without showing them the math.
Absolutely. And the fix isn't to dump a complex financial model in the appendix. The suggestion is to integrate a high-level overview of the financial assumptions.
Or the peer group multiple that was used.
Exactly. That's what transitions the argument from an analyst says X to the valuation implies Y revenue at Z multiple. You're showing your work.
So we're enhancing the completeness and focus here. How do we do that concisely? I mean, since POET is pre-profit, using price to sales, PS, is pretty standard. Should we maybe reinforce that choice?
Yes, reinforcement is key. We have to focus on PS because POET is a classic pre-profit growth story.
Right. Revenue is the driver, not earnings.
So we should start by just specifying the implied PS multiple that the 7.77 valuation suggests, maybe based on a projected 2027 revenue target.
Okay.
That immediately allows a sophisticated reader to judge if that multiple is, even in the right ballpark for the sector.
Let's use a hypothetical. Say the 2027 revenue requires a 15x PS multiple to hit 7.77. The report should just state that. But then the pushback comes immediately. 15x is a premium valuation. How do we defend that?
And that's where the comparison becomes so powerful. If we name the multiple, we absolutely must defend the premium. We need to argue for the proprietary nature of the technology. What's the moat?
But technological advantage?
Yeah. What justifies putting POET closer to, say, a high-growth silicon photonics specialist instead of just a commodity component provider?
That makes the evaluation defense strategic. It links the tech section right back to the financials. Okay, what about the comparables? The report mentions comparable semiconductor multiples, so
We have to name them.
we should identify one or two specific companies.
Absolutely. Naming the comps makes the logic instantly robust and defensible. But here's where we need to add a little friction. We have to acknowledge the potential weakness in that comparison.
Okay?
For instance, if Company A and Company B are trading at, let's say, 18x forward sales, and your 7.77 target for POET implies 15x, well, that looks conservative, which is good.
But aren't those comps way further along commercially?
That's the counterpoint. That's exactly it. If we're comparing a newly commercialized company like POET to established multi-billion-dollar firms, there's a risk of inflating the multiple. The risk profiles are just different.
I see.
So the report needs to proactively address that. We could suggest that while comps A and B are established, POET's early-stage disruptive tech warrants a similar or maybe slightly discounted multiple because of its higher gross potential from a smaller base.
Even with the execution risk?
Even with the execution risk. By acknowledging that difference and then justifying the multiple anyway, the analysis becomes credible. It becomes very hard to challenge. This whole section then turns the valuation from a guess into a calculated projection.
That moves the valuation from a passive citation to an active argument. That's exactly what a quality analysis needs. Okay, so we've established the 7.77 target can be sound.
Right.
But the market needs a reason to move now. This brings us to the centerpiece of the bull case. As I understand it, the argument is that the $5 million production order is the primary driver here. It validates the shift to commercial reality and de-risks the investment.
That catalyst is clearly identified, which is great. But the analysis needs to do a better job of contextualizing that $5 million figure within the broader market.
Okay.
It's correctly identified as the primary catalyst, but the report should better contextualize its quantitative significance. We need to move past the qualitative idea of de-risking.
So we need to enhance the significance and relevance of that order. The analysis focuses a lot on the qualitative side, that it's a real production order, not just a sample.
Right.
But it kind of neglects to establish its quantitative magnitude relative to the total addressable market for 800G and 1.6T.
And the numbers really highlight this gap. I mean, Q3 2025 revenue was only about $298,000, so a $5 million order is an enormous proportional win.
It's huge.
But if we want to talk about the long-term exponential growth needed for that 55% upside, $5 million is a tiny fraction of a multi-billion-dollar market.
I see the challenge.
The report needs a clearer link showing how this one initial win translates into that massive future trajectory. It has to stop being a one-time milestone and start being the first proof point of a trend.
So the suggestion is to use that $5 million figure to project a more explicit, believable growth ramp. Or, quickly position it against industry estimates for component demand.
Exactly. We have to shift the focus from de-risking into scaling the operation to hit that target.
Let's make this actionable then.
Okay. First, we should quickly calculate the order size as a percentage of the company's projected 2026 minimum revenue.
And then use that to model how many similar orders they'd need per quarter.
Yes. How many orders would be needed to support the exponential growth curve the analysts are talking about?
That gives the reader a roadmap. If the low-end revenue estimate for 2026 is, say, $40 million, which you'd need for the valuation, the report could show they need roughly 7 more orders this size over the next, 6 to 8 quarters?
It validates the growth target. And it gives the reader something measurable to track. It ties the whole analysis back to reality.
I like that.
And the second point, for context, is critical. The AI narrative.
Of course.
The report needs to leverage the company's identity as an AI infrastructure play. We need to briefly mention the immense multi-billion-dollar scale of that market.
By noting that this $5 million order represents a beachhead in that enormous market.
Yes.
The narrative shifts. It's not just a small order for a small company, it's a foundational win for a disruptive tech targeting hyperscale data centers.
And that context is what justifies the 55% upside. We're not betting on next quarter's earnings, we're betting on the potential to capture a small slice of a rapidly expanding market. It enhances the quantitative analysis with the necessary qualitative backdrop.
That addresses the significance of the order beautifully. Okay, let's turn to the technical analysis snapshot. The section notes support at $4.80 and resistance in the $5.05 to $5.20 zone.
Right, indicating a potential breakout?
Exactly, as the stock just reclaimed that $4.95 level.
That technical data is relevant, and it's accurate. But the analysis would have so much more power if it were structurally integrated into the risk and opportunity discussion.
Instead of just being a final, isolated section.
Exactly. The overall structure and flow feels a bit disjointed. We see this a lot, right? Analysis reports just drop in the technical levels at the end, almost like a safety blanket.
So the weakness is presenting the technical data as independent information rather than as a consequence of the fundamental news.
Yes, you're separating the technical evidence of a breakout from the commercial catalyst, that $5 million order that's supposed to be driving it.
The two should be linked.
They have to be. The technical analysis should be the immediate confirmation of the fundamental thesis. The suggestion here is to reframe that data to actively support the risk and opportunity assessment from earlier in the report.
Making the technical patterns a direct consequence of the news.
Right, it tightens the whole flow of the analysis.
That makes the technical section a clear warning and affirmation system for the reader. How do we merge those sections effectively?
We should merge the resistance break discussion right into the conclusion, or maybe the catalyst section.
Okay.
Suggest that breaking through that $5.05 to $5.20 resistance zone will be the market's immediate technical confirmation that the $5 million win is actually being priced in.
So the technical move becomes a forward indicator of market belief in the fundamentals. It's not just a price observation.
Exactly. And what about managing the downside risk? That $4.80 support level is critical, but right now it's just hanging there without any context. We have to explicitly link that support level to the primary execution risk.
Meaning?
Note that if the $5 million order gets delayed, or if future orders don't follow quickly, the very risks that undermine the whole valuation, then a break below $4.80 would likely signal the market is re-rating the stock.
Back down toward that stated $4 long-term support level.
Precisely. That provides a clear, actionable line in the sand that's tied directly to the fundamental risk assessment. It uses the technicals to give the reader an immediate warning sign, grounded in the fundamentals. It transforms a general observation into a highly tactical, integrated analysis.
Tying the price action directly to the core risk strengthens the entire piece. It makes it truly valuable for someone actually managing a position.
It really does.
This has been a very targeted critique, really focused on maximizing the analytical rigor of this report. We've honed in on 3 critical areas to make sure it's bulletproof against skeptical scrutiny.
Right. First was strengthening the analytical backbone of that $7.77 valuation. We need to include comparables and actually justify the PS metric. Second, contextualizing the quantitative significance of that $5 million order against the future growth ramp and the sheer size of the AI market.